you actually might pay more taxes as a result of this tax law change. And I think that's tragic. I actually think they didn't understand what they were doing when they changed the tax law, but they screwed it up for company drivers. We'll talk about that. I think the really good news about a big piece of this tax law is it's incentivizing our economy. And down here on the bottom slide, we're talking about major incentives for fleets and owner-operators to purchase equipment. And it's not just fleets and owner-operators in trucking, it's America in general. With the depreciation laws, a lot of the things that came out, they incentivized growth by reduced tax law and a lot of different things. And that's a result of why this truck show is as active as I've seen it in maybe 10 years, is people are doing really well in trucking. And a lot of that is a result of the tax law changes. So we'll talk about that a little bit. So kind of the just outline that I'm going to go through, because taxes can be really confusing and really involved, and so I'm going to try and stay relatively high level, but the things I'm going to talk about are, number one, pass-through entities. Anybody heard of the pass-through entity deduction that's new for this year? It's a brand new piece of the tax law. So that 1,100 pages they added, a good chunk of it dealt with pass-through entities. It especially affects owner-operators, so we're going to talk about that. Depreciation in Section 179, that stuff is always confusing, and it got even more confusing this year, but there's some really good things for owner-operators in that. Like-kind exchanges kind of ties in a little bit to depreciation, some changes to that, so we're going to talk about that. Deductions, exemptions, and tax credits. So now we're getting in the nitty-gritty, nasty. That stuff is always confusing. A lot of it changed, so I'm going to help you understand some of the impacts you as truck drivers are going to have. And how many people remember the promise that Trump made, I'm going to get rid of Obamacare when I get elected. I don't like it, I'm getting rid of it. Anybody remember him saying that? And so we all remember hearing that this tax law got rid of Obamacare, but I don't really know how that works. But it did have an impact on funding Obamacare, so we're going to talk a little bit about that. And then at the end, we kind of take all this mess of 1,100 pages of tax code, and we kind of put up a spreadsheet that'll help you see 2017 versus 2018, and hopefully it has a scenario for most of you in the room that'll help you understand what you're going from and what you're going to. I have a tendency to talk pretty quickly through pretty complicated stuff, so if I confuse anybody, feel free to raise your hand if you have a question, you want to know more, just stop me. And we got an hour in here, and I don't think my materials are going to take nearly that long, so we can drill deeper if you want. One thing I'll warn you is I'm not a CPA and I'm not even an enrolled agent, so any answer I give you can't be held against me. But I will tell you that at ATBS, we have the largest tax department that deals with truckers in the United States. We do about 15,000 tax returns. So I got a lot of smart people that figured this stuff out for me so I could talk to you about it. But if I don't know the answer to your specific question, because I'm not as smart as all those people in my office, I'll get you an answer. So the pass-through entity qualified business income deduction, which sounds like a big, long, fancy name, at the end of the day, let me just explain to you why we got it. And most of you probably remember during the campaign and even after, when Trump was talking about the U.S. corporate tax rate at 35%. It's unfair. It's the reason that all of our corporations have offshored all their manufacturing. It's the reason we have trillions of dollars spread around the world that don't come back to America. And one of the biggest things he campaigned on was, he said we need to lower our corporate tax rate to make it more competitive. We need to get it from 35% down to 21%. And then these trillions of dollars will all come back to America. They'll be reinvested. We'll move all these jobs home. And that was a big piece of his platform. And so for the average common person, they don't really even know what that means. It just sounds like the rich big corporations are going to get a lot of money. And at the end of the day, Trump got that done. But, you know, big corporations mean a lot to America, but what America is really built on is small business, like you and me in this room. And so what they really realized when they did this tax reform is if they just take the corporate tax rate from 35 to 21%, the next election cycle, a lot of us are going to be pissed off because all those big greedy corporations got tax cuts and we all got screwed. And so they had to figure out a way to get all of our tax rates down. You would have think they'd have done something simple like, say, we reduce their tax rates by 15%, let's just reduce all our tax rates by 15%, but in government wisdom, they never do it simple, and so they created this big, fancy, complex, qualified business income deduction. At the end of the day, what it really means is if I'm a small business owner, I can deduct off of my net income an additional 20%, really kind of as an expense. And so let's just say I'm an average owner-operator and I'm doing $150,000 a year in business, gross revenue. I spend $90,000 in expenses. I'm going to net $60,000 in my business. So prior to reform, that's what my tax was based on, was that net income of $60,000. What this qualified business income deduction said we can now do is take an additional 20%. So I take that 60,000 times 20%, and now my taxes are only based on 48,000. So it's going to save me a few $1,000s in taxes. Again, it's complicated. Why the heck do we just get in another deduction for 20%? But that's what they did. In the end, it's a good thing, and that's where that couple $1,000 tax saving for owner operators comes from. And it kind of levels the playing field between the big corporations that went from 35 to 21. It's going to lower, the effective ultimate tax payment for small businesses. The good news is there was a lot of confusion at the beginning of the year when people heard about this, and they thought, man, I need to get a C Corp set up, I need to be an LLC, I need to be an S Corp. The good news is this pass-through entity is defined as anybody that's a small business. I can be a sole proprietor doing business under Joe Blow Trucking, my name. I don't have to be an LLC, so you don't have to change your corporate structure at all. You'll get it if you're a small business, and you pay taxes individually on what you make in your small business. So it's good news. We'll talk a little bit more about that. Second thing that I'm going to kind of gloss over in a big picture because it can be really crazy, depreciation. We have a lot of the tax code dedicated to some crazy depreciation rules. There's accelerated depreciation, makers, acres, 3-year, 5-year, 7-year property, all this, recapture, all this kind of stuff. What they did with this tax law, which is a good thing for all of us for 2 reasons, is they allowed us to depreciate any asset that we buy 100% in the year that you buy it. And that works for small businesses and that works for huge businesses. And so one of the reasons that freight is booming for all of us is that this incentivized. We all heard Boeing, had orders for billions of dollars of jets right after this tax law was passed. Truck order boards are a year out. We're making more trucks today than we've ever made in the history of trucking. And one of the big reasons that's happening, and it's happening in every industry, not just trucking, is because people are incentivized. If whatever they buy this year, they can depreciate, which means they'll essentially offset all of their income and pay no income tax. It's almost like I'm getting free investment on the government. You saw a lot of public reports. If you read public reports of any of the big companies, from Knight Swift or Schneider or J.B. Hunt, their earnings per share went up by 30% this year. The minute that tax law was announced and their accounts could go through the numbers, their earnings per share forecast went up just because their effective tax rates went down significantly, because a lot of them are buying a lot of assets right now and they depreciate them. So what does that mean to you? If I am an individual trucker, there's a lot of flexibility. That's the good news, is it gives us ultimate flexibility. We're going to talk in a minute about the standard deduction. And the standard deduction went up for married people from $12,000 to $24,000, for individual people from $6,000 to $12,000. And I'll get into details on that in a minute, so I don't want to kind of sidetrack us here. But what that means is I don't necessarily want to write off all my income down to zero, because then I'm not taking advantage of that $12,000 or $24,000 standard deduction. I may want to depreciate my truck still over 3 years, but at the same time, if I'm having a great year, things are good, and I don't want to pay taxes, maybe I want to write off 100%. I'm going to buy a new truck this year. Ultimately, what it means is this gave us a lot of flexibility to do what we want with your taxes. And it's confusing, and we got to run a bunch of scenarios. So I can't sit up here and tell you the right thing to do, because every single person's different. The thing you should take away is it gave us a lot of flexibility in filing your taxes as far as depreciation on your truck goes. So the second thing I'm going to talk about, kind of related to depreciation, is Section 179. Does anybody know if they've ever taken a Section 179 deduction as a small business? A couple of you out there. The Section 179 is a good deduction, and it's been around for a long time, and it was set up for small businesses. It's kind of a mini depreciation schedule that allowed small businesses in the past up to $500,000. You could write off 100% of what you purchased in the year that you purchased it. They know that what I just talked about, the bonus depreciation, scales out over the next 5 years, and we'll have a new administration at some point in the future. And so what they said is, we want to keep the economy going, and as we scale out this bonus depreciation so people can't depreciate all in the first year, we want to keep small businesses buying and growing. And so they increased the maximums on this Section 179 from $500,000 to $1 million. So when bonus depreciation goes away in 2022, you'll still be able to write off up to $1 million of your assets, which is a good thing. And again, this is kind of technical, getting a little deeper in the tax law. So if it confusing or too deep, we can talk after or give you some more information on it. A like-kind exchange. Anybody know that their tax person has done a like-kind exchange when they've traded in their truck? You may not even know it, this happens behind the scenes, but what happens if you've been in the business for a while and you buy a new truck, you probably already depreciated your old truck down to zero. And if you just sold that old truck, the IRS says you depreciated it down to zero, but you sold it for a certain amount, let's just say 50,000. They want you to pay a gain on that 50,000 because you wrote off the expense down to zero. You used to be able to do what was called a like-kind exchange, and you just simply trade that truck. So I go buy a new $150,000 truck, I trade in my $50,000 truck, I don't have to pay a gain on that $50,000 truck I sold because I just traded it in, and my new basis is $100,000. That like-kind exchange went away. They just eliminated it as part of the new tax law. That doesn't necessarily mean you're going to pay a gain when you get rid of that $50,000 used truck and buy a new truck, because the new depreciation laws essentially offset that. So they just said this is an unneeded part of the tax law, let's just get rid of it. So you'll no longer be doing a like-kind exchange. Deductions, exemptions, and tax credits. So I'm going to talk for a minute just to define deductions, exemptions, and tax credits because they're confusing. And deductions and exemptions, you can simply think of those as things that reduce your amount that your tax is calculated on. So if I'm a company driver or an owner-operator and I make $50,000 a year, that's my adjusted gross income, any deduction or exemption I get off of that reduces the amount. So $50,000, let's say I get a $1,000 exemption or deduction. That means I get down to $49,000. That's what my tax is calculated on. A credit, on the flip side, is a dollar for dollar reduction in my taxes. So let's say on that $50,000, I owe $8,000 in taxes. If I get a tax credit for $1,000, I actually am going to go from owing $8,000 down to $7,000. So deductions, exemptions, credits, it's always confusing when I hear they tweaked this or did that. And I'm not going to get into a ton of detail on credits because there weren't a ton of changes that impact truckers, but deductions and exemptions were changed significantly. So I touched on this a minute ago. This is a big deal probably for everybody in this room because in the end we all file a personal tax return, whether we have a big company, little company, sole proprietor, or whatever. In times past, a lot of us may have itemized deductions on a Schedule A on our tax return, especially if I'm a company driver. You may schedule out things, home mortgage interest, per diem, a lot of those kinds of things. And I think the reason the IRS did what they did, and you can see on here, they took, if I'm married, filing joint, they took the standard deduction from $12,700 up to $24,000. They essentially doubled it for every category. If I'm a single individual, not married, and I file a single tax return, they went from $6,350 to $12,000. I think the reason that they did that is the IRS just thinks that we're all a bunch of cheaters, and maybe we are. We don't like to pay the government taxes, and so we do everything we can to pay the least amount we can. And so they think that they're maybe forcing us all to be fraudulent tax form filers by getting everything we can in there to reduce our taxes. So I think they kind of looked at their data and said, the average American, if we take their home mortgage interest and their state tax deductions and their medical expenses and all those things that used to get itemized on Schedule A, 98% of filers fall under $24,000 if they're married. And if they're single, they fall under $12,000. So let's just double the standard deduction and not make all these people have to cheat on their tax forms and put everything they can in there to lower their taxes. And I might be exaggerating a little bit, but at the end of the day, what this means is it's going to eliminate itemized deductions for just about every American. So this really, truly, when you said, are my taxes going to be simpler this year? If I'm just a simple employee working for a company, I get a W-2, and I don't have a lot of extraordinary stuff, I probably am going to be able to file my return on a postcard. I'm not going to have to track my mortgage interest and do all that stuff I used to have to do. I'm just going to have a standard deduction that's pretty significant. So that is probably the only place they did simplify the taxes. And it's a good thing in a lot of ways for all of us because doubling that standard deduction is going to save us money on taxes. So the takeaways from deductions, exemptions, and tax credits, bonus depreciation is a big deal. It allows us some flexibility in reducing our income so we lower our taxes. But beyond that, the thing you got to keep in mind is it has spurred a lot of economic growth this year. People are buying stuff. There's imports and exports. There's steel moving. There's all kinds of stuff moving throughout our country because people are buying things because they can depreciate it 100%. There's a lot of investment. Every town I go to has got a new crane in the sky. It's because corporations are investing because they can depreciate a lot of this stuff and offset their taxes this year. The increased standard deduction will benefit just about anybody that's not itemizing. And going forward, this is a bad deal. I'm going to talk about the per diem for company drivers. Going forward, a lot of people that have itemized in the past are not going to have to itemize. So I'm going to talk about just some of the common things that maybe we've all dealt with in the past as far as deductions go. So anybody on here experienced significant medical expenses that they've had to itemize on a Schedule A? Once in a while that happens. If I have, in the past more than 10% of my adjusted gross income in medical expenses, I could itemize and get a deduction for that. They actually lowered that to 7.5% this year. That's a good thing. State and local property taxes. We heard about this. We heard that I'm no longer going to be able to deduct my property taxes. A lot of people, you heard on the news, paid their property taxes on their homes last year because if you did it last year, you could include it on last year's tax return. This year, you can't do that. And they tweaked that right at the end and they limited it to $10,000. Probably not a lot of people in the room have a property tax over $10,000, so it really doesn't affect us. Mortgage interest, we heard about the same thing. They're going to eliminate the mortgage interest deduction. So it went from a home mortgage of $1 million down to $750,000. Again, these are kind of big rich deductions, and it's funny because we always hear that Trump's tax bill, and I'm not up here making any political statements, but the media likes to play it that Trump is in favor of the big and rich. These are things that hurt the big and the rich that have $1 million mortgages, not you and me that have $250,000 mortgages. Miscellaneous deductions, moving expenses. Used to be able to deduct your moving expenses on the Schedule A. No longer can they be deducted except for military people, which is great. I'm glad they left that in there. Miscellaneous deductions, this one kind of upset me because I'm in the tax business. And so if I'm an employee, I can no longer write off the tax preparation fees that my company charges me. Good news is if you're a small business or an owner-operator, you can because you still have a Schedule C that details your business expenses, so you can write off those. The last one is non-reimbursed employee expenses. Does anybody in here understand per diem expense? Is it something that confuses a lot of people that you talk to? Like they hear it's changed, they hear it's gone away, they don't know what's going on with it. This is one of the biggest changes that's happened with the new tax code. And so I want to spend a little bit of time talking about it. So I want to give you an example. I hope you can see that up on the screen. But essentially what happened is, as part of the tax code, again, I'm kind of a conspiracy theorist, and I think the government looks at us all like a bunch of tax cheats. And so when I come down here for the GATS Truck Show, let's just say I'm going to have fun tonight, and I'm going to go out and entertain some people, and I'm going to spend $300 on a nice dinner. And I go back to my office, and I turn in my expense report, and my office says, hey, we got a rule. You can't spend over $50 on dinner. You spend $250 more. We're not giving you that. We're only giving you $50. In the old world, I could take that $250 that the IRS, that I did not get to expense, and I could write that off on my own personal tax return and call it a non-reimbursed employee expense. My company didn't let me expense that, so I can get a tax deduction for it. Again, I think the IRS thinks people cheat on those kinds of things, and so they said, we're just going to eliminate that, non-reimbursed employee expenses. That's what per diem is. If I'm a company driver, when you're on the road, your meals and incidental expenses on the road, the per diem deduction are non-reimbursed employee expenses. They did away with it, and so I no longer, as a company driver, can take an itemized Schedule A per diem deduction. That's a big deal because it's a big deduction for most company drivers. So just to walk through the numbers in 2018, what that means for you if you're a company driver. You can see on the left, this is a person who's not going to take the per diem deduction. On the right is the person who is going to take the per diem deduction. So let's just say this driver's company driver making 50 grand a year. A per diem deduction is typically, it's $63 a day is what's allowed by law. And let's just say an average driver's away from home 250 nights a year. So $63 times 250 nights a year, the IRS allows you to deduct 80% of that. And so that's where we come up with roughly $12,500. So on the right, we get our wages down to $37,500. We're getting paid, and we're deducting the per diem of $12,500. So when we go down and see what that actually means, so in the end, we've got a net taxable wage of $37,500 if we're getting the per diem deduction. We've got $50,000 if we're not. We take the standard deduction, which I've already talked about for a single taxpayer of $12,000, and we get to take that off. So my true taxable income on the left is $38,000 if I'm someone that doesn't get the per diem deduction. If I am doing per diem deduction on the right, I have $25,500 of taxable income. So bottom line is, if I take my individual income I gotta pay, and my Social Security and my Medicare I gotta pay, and I tie those together, the difference between per diem and no per diem in 2018 is almost $2,500. When the tax law first came out, I was on quite a few radio shows on satellite radio with a bunch of hosts, and almost our entire hour or 2 hours was taken up by drivers calling in and talking about per diem because this was really confusing. And we had drivers that would call in and we'd go through the scenario, and honest to God, the single truck driver that files a single tax return that is a company driver got screwed really bad by this tax reform. They're gonna lose this amount of money. And I don't really think that was the intention of our government. They didn't want to screw the little man or the truck driver. It's just they didn't think about the ultimate detail effect of removing that non-reimbursed employee expense. There's one way. Let me just show you. If you're married and you're a company driver, the numbers are at the bottom. If you file jointly, it's not a lot different. It's $2,300. There's really only one way to solve this problem if you're a company driver in the room. You have to drive for a company that pays you a split between regular pay and per diem pay. They still allow a company to take the per diem deduction. So I can still pay you as a truck driver employee of mine. I can pay you, let's just say 30 cents a mile regular pay, and I can pay you 12 cents a mile per diem pay. I can still deduct off my tax return as a big company that 12 cents a mile as reimbursement for your expenses on the road. It's not taxable to me and it's not taxable to you. So my only advice is, if you're a company driver or if you own a truck line, you need to set up a per diem pay structure, or you need to drive for a company that has a per diem pay structure, or you're losing a couple grand in taxes. That's the worst thing for truckers that came out of this tax law. Everything else is good. Does that make sense? Anybody got any questions on that? It sucks. It really does. We have a good lobby in trucking, and we talk to the government, through associations, through a lot of people, and I'm hopeful that we may get this reversed or changed once they realize the bad deal it is for, actually company truck drivers, but for now, it's the law. So takeaways from deductions, exemptions, and tax credits. They changed almost every category of itemized deductions individually. The good news is most of us don't have to worry about it because we're going to go to just filing a standard deduction. Most of us will not itemize anymore. So we've already hit on most of those takeaways. The Affordable Care Act, so I said in the beginning, we all heard that Trump was sneaky and got in the back door and got rid of Obamacare, but what does that really mean? I don't know, because Obamacare is still around, but the thing I do know is I believe they took away the funding mechanism for Obamacare. They eliminated the penalty. So immediately when a lot of people heard that, they said, oh great, I don't have to buy that state health care program that didn't do any good for me anymore anyways. And that's true, but that's not true until January 1st of the coming year. And so if you're driving this year, you still are subject. If you haven't filed your return, you got till October 15th of this year for last year, but also for this year, if you do not have health care that meets the Affordable Care Act insurance requirement, you will pay a penalty, and we're seeing those penalties all the way up to a couple $1,000s. So just beware, we got to file the form that proved that you had your health insurance for every month of the year, or you're subject to a penalty. But the good news is that goes away next year. So I'm going to ask you guys a personal question and you gals a personal question, because there's a lot of husbands and wives in here. Who's not getting along too well with their spouse sitting next to them right now? Okay, we got a couple in the back. Anybody else back there? Oh. So I say this a little bit as a joke, but it's actually a fact. If husbands, if you're not happy with your wife, or wives, if you don't like your husbands, get divorced this year. It's a sad thing to say, but the reality is alimony will not be deductible as an expense on your tax return after this year. If you file a divorce decree and you have to make spousal payments up to December 31st of this year, those are tax deductible. So I'm not advocating anybody in here get divorced, but I'm just saying if you're not getting along, you might want to think about it a little quicker and not just keep fighting and going to counseling. Tax brackets. So this is good news for everybody in the room. And the reason it's good news is because all of our effective tax rates went down. So for the single tax filer, you can see up here kind of the red. You can see where we went from the old tax rate, which is on the left-hand side, to the new tax rate, which is on the right-hand side. And a lot of people don't understand because it's usually some, TurboTax or some agency or some company that figures out taxes. So a lot of them don't understand what the actual tax rate means. And the way taxes work is it's kind of a tiered system. So a lot of people think when taxes are going from, if we look on the left, I'm going to go from making, sorry, my pointer's not working real good, but I'm going to go from making, $38,700 to $38,701. My tax rate's going from 15% to 25%. I'm going to stop working. If I make one more dollar, my tax rate goes up 10%. The way the tax rates work is it's a tiered system. So it's on the first $9,525 in the old tax law. I got taxed 10% on that. In the new tax law, I get taxed 10% on that. But when my next $9,500 to $38,700, the tax rates went from 15% to 12%. So I got a 3% tax rate deduction on that tier of taxes. And then if I make money over $38,700, my tax rate all the way up to $93,000 went from 25 to 22%. So the good news is overall, there's an average tax rate deduction of 3%. So again, let's just do the numbers. And if my average tax income, adjusted gross income's around $50,000, that's about $1,500 in savings. That's a good thing. The same thing happens, this is for the single taxpayers. For joint taxpayers, the numbers go up a little bit when I file a joint return, but the good news is the end result is the same, a 3% reduction in tax rates. So takeaways kind of for this section on tax rates, most of us will benefit from a lower tax rate. In no category do tax rates actually go up. If you paid attention on there, the people making $500,000 or more, again, Donald Trump's really rich friends, and I'm not making political statements, but all you hear on the news is this favors the rich. That tax rate really didn't change much. That kind of $300,000 to $500,000, that tax rate didn't change. It's the people, the average American that's making $50,000 to $150,000 where rates went down 3%. The good news is, again, that's why we're all sitting here really happy in trucking, because we're all making a little bit more money. We're making an extra $30, $50 a week in our paycheck, and we spend that money. We go out and buy things, and so that spurs economic growth. So in the end, those tax rates have been a good thing, and that's why trucking is doing so good right now. Company drivers, one of the things that they really wanted to do, and the reason they implemented this at the end of last year, if you remember, it was kind of crazy. We heard about it, and then all of a sudden at Christmas it was here, and I can tell you our tax department literally spent the holidays, Christmas Eve, New Year's, they spent those days off analyzing this new 1,100 pages of tax code. The reason they wanted it implemented because they wanted it to affect us this year. They wanted our withholdings if we're employees. If my paycheck as a company driver is $1,000 a week net, they wanted my net paycheck because taxes are going down to go up to $1,050. So I'm spending an extra $50 every week and growing the economy. Same thing for owner operators. The estimated tax payments are lower just based on the tax rate. So they hurry up and got all that implemented at the beginning of the year. For some reason my clicker's not making my slides go. There we go. Expected future tax liabilities. So this is a big hairy looking spreadsheet, and what we tried to do here is take something for everybody in the room and help you see, it won't be your exact numbers, but it'll kind of help you see the net effect of what's going to happen to you. So on the left we've got company driver, 2017 the old world, 2018 the new world under the tax law, the change. Then we got the owner-operator, which 95% of owner-operators they're sole proprietors. So we've got the old world as a sole proprietor, the new world as a sole proprietor. Then we've got owner-operators that are set up as an S-Corp compared to the old world, the new world. And then on the far right, we didn't do a comparison because the C-Corp just never makes sense for anybody. So I think I'm having to have you guys maybe run my clicker for me. There we go. So I put a big X through C Corp because at the end of the day, for most people sitting in this room, a C Corp just does not make sense. There's double tax implications if you take money out of the company. So if anybody ever talks you into setting up a C Corp, give me a call first, because unless you're a $1 billion company with a lot of assets and you're going public sometime soon, it makes almost no sense. So if we move over to the company driver side and we look at the difference in company drivers, I already talked a little bit, but this is with the per diem going away. If I am not with a company that's paying me per diem pay, I'm going to lose close to $600. So you may remember a few slides back, I said the difference was $2,500 between me having per diem and not having per diem. That was just a 2018 comparison of per diem, no per diem. This is taking the tax law changes and the rate changes and putting all that together. So if I'm a company driver in 2017 going to 2018 and I lose my per diem pay, the net, I'm going to gain from a lot of those tax changes, but I'm going to lose my per diem. So the net is I'm going to lose $600 of true cash. Again, that's a horrible thing. Hopefully we'll get it changed, but if not, it's a bad deal. So the next one we're going to talk about is the owner-operator sole proprietor. Sorry, go forward a couple clicks if you can, like one more, there we go. So 2017 versus 2018 for the sole proprietor, which is probably what most of you are if you're an owner-operator. You probably don't have an LLC or an S-Corp set up. Good news is you're going to save about $2,400 in taxes last year versus this year. Your tax liability if you're single is going to go from about $13,000 down to $10,500. If you file joint, down on the bottom, it's going to go from $10,800 to $8,900. And again, that takes all the tax law changes, the itemized deduction that increased and all those things. So, that's awesome. I mean, that's a pretty significant reduction in the tax rate. So if we go to the S-Corp owner-operator, it's about $1,900, almost $2,000. So good news is it's a significant amount of money. So the one thing I really kind of want to leave you with is what's the best structure for you going forward. I already said you don't have to change and become an LLC, become an S-Corp, become a C-Corp or do anything to get that qualified business income deduction. But we're in a time where truckers are making a lot of money. Our average owner-operator at ATBS, dealing with tens of thousands of owner-operators, is making more money than they've ever made on average. We'll be talking about those numbers tomorrow afternoon if you got time and you're around through some of our benchmark data, but they're almost at $63,000. Just a year ago, they were at $59,000, so it's going up a lot. There's a little bit of a tax game you can play that, not a little bit, it's a significant tax game, but it's legal. You can actually set yourself up as an LLC or an S-Corp, and you can pay yourself a wage in your company, and you can pay yourself a lower wage than you actually make in your business. And so that gets a little bit complex, but at the end of the day, what you really are doing is saving money on self-employment taxes. And we've got kind of some rules of thumb numbers. And it used to be that if you made over $60,000, this structure might make sense for you, and you could save a couple grand on taxes. So when we run the numbers right now, the difference between doing that, if I'm making $65,000, I can save about $2,200 a year just between being an S-Corp and paying myself as an employee of my company versus a sole proprietor. So that's some relatively complex tax planning. There's a lot of details. I actually have to pay myself a wage. I got to do withholdings. I got to remit them to the government. There's a lot involved. You can't just say, I'm going to fill out some paperwork and become an S-Corp and do this. There's a lot to it. And it's somewhat complicated, but at the end of the day, if I can save a couple $1,000, $2,200, it might be worth doing. We have owner-operators making six figures today, making 100 grand. So I can assure you, if you're making 100 grand today, we'll probably save you $5,000 to $8,000 in taxes by setting up a structure like this. It's not cheating, it's not illegal. The IRS understands it, allows it. It's a real thing, and a lot of businesses do it. So if I can leave you with one thing, if your income has gone up this year because trucking is doing really, really well, think about what you're doing with your taxes and at least get some tax advice from your tax company and make sure they're doing these kinds of things for you. So tying it all together, everything that we've talked about, and I'm going to be around afterwards. If you are in tax trouble and you just didn't want to raise your hands, feel free to come up and I can talk to you about that. We do tax resolution a lot, unfortunately. There's a lot of people that get in tax trouble. So lower corporate tax rates and bonus depreciation are incentivizing purchases. I've already hit on it 3 or 4 times, but I think the biggest question of most people I talk to at this show is, how long is this going to last? We're having the best party in trucking we've had forever, and nobody wants a good party to end. We'll all stay up till 5 in the morning if they keep the beer flowing. How long is the beer going to flow in trucking? I don't think anybody knows that question, but I think it's going to flow longer than a lot of us expect, because people just didn't go out and buy all their assets at the beginning of the year and it's all done. It's a complicated tax law change, and there's a lot of other things going on. So I think we're in a good economy for a while. it's not going to be the best that it's been, for the last 6 months. It might slow down a little bit, but all this tax reform is spurring a ton of economic activity, which means we all got to haul freight to, meet those economic needs. Everybody's making more money in America in trucking, and when we make more money, we go upgrade trucks, we buy new cars, we might sell an old house and buy a better house. All that spurs economic activity. So all that stuff isn't going to just drop off a cliff one day. So my opinion is we're into this well into next year, if not, 2020. So I think trucking is going to be good for a while. Most taxpayers, except poor individual single company drivers that don't get paid a per diem, are going to benefit from lower tax rates and all the things that have been changed. Due to the pass-through, or the new 20% qualified business income deduction, we believe at the end of the day, the average owner-operator is going to save $2,000 on taxes, and the company driver is going to have to pay more if you don't get with a program that pays per diem pay. So that's really my presentation. I'll tell you one more thing, and I should have said this at the beginning because I saw a lot of you taking a lot of notes. We did an ebook on this tax reform change, and a lot of the stuff that I covered is in an ebook. If you go to our website, atbs.com, there'll be a little pop-up in the bottom right, and you click on that, and we'll send you the ebook. It's maybe 18 pages long, and it'll go through a lot of this stuff and help you understand it, probably better than I could explain it to you on this stage. If you want to get a hold of us, if you owe the Beatles tax man some money and he's after you, give us a call. We do tax resolution all day long. We're not like those companies on the radio that charge you $5,000 and never do any work. We just want to help you get out of trouble and get you back as a good tax-paying citizen making money. So we'd be happy to help you with that. So that, I'll stop, and I will ask if you got any questions. If you do have a question, a lot of times, people in the audience will have the same question, so don't be afraid to ask it. Yes, sir. They got a microphone, I guess, just so everybody can hear it.
So, did you equate an LLC and an S Corp in the tax savings?
Yes. So, those are really two different things, and the way that it works the best, in my opinion, is it's a legal entity at the end of the day, an LLC and an S Corp. An LLC is the simplest legal entity to set up, maintain, manage. S Corp can get a little bit more complicated from a legal perspective. I'm not a lawyer, but a lawyer should answer that question. From an accounting perspective, you can be an LLC and elect to be taxed as an S Corp, and that would be my recommendation from a purely accounting and tax perspective, is that you set up an LLC, but you elect to be taxed as an S Corp. As you do that, that's when you set up payroll and do all that payroll, and that's how you can get the tax savings. Does that answer your question?
Yeah, that answers. I got one more question.
Yes, sir.
We'll go back to the per diem. Is that a wash for the employer?
Yeah, there's no change for the employer paying per diem pay to their driver. There's no change from their perspective. The only thing that changes is me as a driver, I can no longer itemize per diem on my Schedule A. So I have to work for a company that breaks out my pay as per diem pay.
Okay, thank you.
You bet.
Okay, so the per diem thing.
It's complicated.
So it's the same for the company. The question is, if the company pays per diem, if they break that out on a paycheck, that is then tax deductible for the driver?
So let me just walk you through a number and maybe it'll make sense. So let's just say in simple terms that I'm a company and I'm going to pay you as a driver pay, as an employee truck driver. I'm going to use simple numbers. I'm going to pay you 40 cents a mile as a truck driver. That's taxable to you, that's taxable to me. So you got to pay income tax on that. You got to pay your half of Social Security and Medicare, which is 7.5%. I got to pay my 7.5% on your behalf of Social Security and Medicare. And then you also have to pay your share of income tax on that 40 cents. If I don't get any per diem, all that happens on 50 cents a mile. If I pay you per diem pay, I'm going to pay you 40 cents a mile. All that happens on 40 cents a mile, but I'm going to pay you per diem pay of 10 cents a mile. So per diem pay for me as a company is deductible, tax deductible, just like my wage to you is tax deductible, but I don't have to pay as a company any Social Security or Medicare, 7.5%. You, as an employee, don't have to pay any Social Security and Medicare on that 10 cents a mile of 7.5%. But even better for you, that's a reimbursed employee expense, so it's not taxable income, so you pay no income tax on it. So that's where the numbers get big, is you pay no Social Security, Medicare, you pay no income tax. For me as a company, it's really no wash, because I'm gonna save as a company the 7.5%, which is a decent number of Social Security and Medicare, but there's no income tax implications for me as a company. I still get to deduct all that off my taxes. Does that make sense? Okay. The way it was last year is the very same if you had that structure last year, but a lot of companies didn't set up per diem pay, because if I just paid you 50 cents a mile as a driver, then I just take that deduction on my return and I paid you 50 cents a mile, that's an expense. But you as a driver could take that 10 cents a mile times the miles you drove. Let's say it's 150,000 miles. You could take a $15,000 deduction on your itemized Schedule A, and you could reduce your taxes that way and not pay Social Security, Medicare, and income tax. They eliminated that. You, as an employee, can no longer itemize per diem deduction on your Schedule A. So it doesn't change for me as a company, but what does change is I think a lot of companies look at this and they realize, you, as my driver, the world changed, and so you're gonna lose a couple $1,000s in tax benefits. Maybe I need to look at my pay structure, because it helps you. It's like giving you a pay increase of a couple grand, even though it's just on taxes. And so smart companies will set up a per diem pay structure for their company drivers. They have no choice, because when drivers file their taxes this year and realize that I no longer have that Schedule A itemized deduction, and I lose a couple grand in taxes, I'm gonna become an owner operator where I can deduct per diem, or I'm gonna look for a company that will pay me per diem pay. Like I say, I literally spent 2 hours on the radio back to back with 15 phone calls talking about scenarios. So it's confusing, it's different by every driver and every circumstance. It should be simpler, but it's a big deal. Yes, sir.
The 10 cents you're talking about, is that a max? Is it $63 a day? Like, we need to figure out what that...
So the fact is it's $63 a day, and if the IRS had its way, they would want you to do $63 a day exactly for every driver that's away from home. But when you have thousands of dollars or thousands of drivers out there, it's almost impossible to calculate that. And so what a lot of companies will do is just take an average and say our average guy drives 500 miles a day, and if I take 12 cents a mile times 500, that's 60 bucks, and they'll be just below. If you're over, you're cheating the IRS, and they're gonna get mad if you're at 60 versus 63. So a lot of them will do it on 12 cents or something right around there based on the length haul. But the true exact formula is $63 a day for every day you spend a night away from home, and then you can deduct 80% of that. There's another little tweak in there. Anybody else? Yes, sir.
So, as an employer, I pay a per diem. That reduces my FICA liability. Is that correct?
True.
Okay. So that actually is a plus for me.
It is.
That not correct?
It is.
Okay.
It's a good thing for you, yeah.
Yeah.
It'll be a benefit for you too. It's a little complicated, so make sure your CPA firm as an employer makes you set it up right, because if you don't do it right, you go over like he's saying and you pay 18 cents a mile, you wind up deducting $75 a day and you get audited, the IRS gets mad and gets you in trouble. So you saw in the past a lot of companies that gave a driver an option. You can choose per diem pay, and we'll pay 50 cents. Straight pay, or we'll pay 48 cents total, but we'll pay 38 cents per diem and 10 cents per diem and 38 straight pay. And they kind of played that game because they knew you had a tax benefit, and a lot of drivers would choose to do it one way or the other. But at the end of the day, I think we'll have one way going forward, and I think it's the company pays per diem pay, and you both benefit from it. Anybody else? All right, well, I got a red ticket for somewhere out there that said they were serving beer, I think, at 4 or 4:30, so I'll meet y'all there. Thank you for coming. Appreciate you being here.